Financing your new practice. Hi, I'm Dr. Stephen Smith with Start My Practice. Today we're talking about money, specifically how to fund your new practice. This is the topic that stops more physicians from making the leap than almost anything else. They have vision, the clinical skills, and the drive, but they don't know how to capitalize a practice, and they're afraid to ask. Let's fix that. There are more options available to you than you probably realize, and some of them are surprisingly accessible. First, know what you're financing. Before you approach any lender or investor, you need to know your number. Startup costs vary widely depending on your practice model. A cash pay functional medicine practice with leased space can launch for $50,000 to $150,000. A primary care or urgent care practice with full staffing and equipment runs $150,000 to $500,000. A procedure-heavy practice, imaging, surgery, regenerative medicine, can require $500,000 to several million. Build your pro forma first. Know your startup costs, your monthly burn rate, and how many months it will take to reach break even. No serious lender will talk to you without it, and frankly, you shouldn't be borrowing money without it either. There are several ways to finance a new practice, and each comes with its own trade-offs. Here's a breakdown of the most common paths. Option 1. Traditional business loans. The most straightforward path is a conventional business loan through a bank or credit union. You borrow a lump sum, repay it over a fixed term with interest, and the lender typically wants collateral. Equipment, real estate, or a personal guarantee. For physicians, many banks have dedicated healthcare lending divisions that understand the practice model and are comfortable with the revenue projections. They know physicians are low default risks. Use that to your advantage. What they'll want to see. Personal credit score. Ideally, 660 or above. Personal financial statement. Business plan with pro forma financials. 2 to 3 years of personal tax returns if you have them. Details on any existing debt, including student loans. Don't just walk into your personal bank. Shop at least 3 lenders. Rates and terms vary significantly, and healthcare-focused lenders will often offer better structures than general commercial lenders. Option 2. SBA loans. The Small Business Administration doesn't lend money directly. It guarantees a portion of loans made by approved lenders, which reduces the lender's risk and makes them willing to offer better terms to borrowers who might not qualify for conventional financing. The 2 most useful SBA programs for practice startups are SBA 7A loan, the most common, up to $5 million, terms up to 10 years for working capital, and up to 25 years for real estate. Interest rates are tied to the prime rate with a cap. This is your workhorse loan for a full practice startup. SBA 504 loan, designed specifically for major fixed assets like real estate or large equipment. If you're buying a building or an expensive piece of diagnostic equipment, the 504 is worth exploring. It typically requires a 10% down payment from the borrower, with the SBA and a lender splitting the remainder. The trade-off with SBA loans is paperwork and time. The application process is more involved than a conventional loan, and approval can take 60 to 90 days. Plan accordingly. Don't start this process after you've already signed a lease. One important note, SBA loans almost always require a personal guarantee. You are on the hook personally if the business fails. Understand that going in. Option 3. Healthcare-specific lenders. There are lenders who do nothing but finance healthcare practices. They understand your revenue cycle, your startup curve, and the fact that a new physician practice almost always runs at a loss for the first 6 to 12 months before hitting its stride. Names worth knowing. Live Oak Bank, BMO Harris Healthcare, Provide, formerly Lendio Healthcare, and various regional banks with dedicated medical lending divisions. These lenders often offer higher loan-to-value ratios than conventional lenders, deferred payment periods during startup, lines of credit alongside term loans, financing for Goodwill and practice acquisitions, something conventional lenders won't touch. If you're buying an existing practice rather than starting from scratch, A healthcare-specific lender is almost always the right call. Option 4, equipment financing. Don't use your working capital or your main loan to buy equipment if you can avoid it. Equipment financing is its own category and often easier to obtain than you'd expect. The equipment loans and leases are secured by the equipment itself, which means the lender has collateral and is willing to lend to newer businesses. You can often finance 100% of the equipment cost with no down payment, and the terms are matched to the useful life of the equipment. For a functional medicine or regenerative practice, this matters a lot. EBOO machines, ozone generators, IV equipment, laser systems, these can be financed separately, preserving your main credit line for operations and working capital. Leasing is also worth considering for technology that becomes outdated quickly. You use the equipment, make monthly payments, and upgrade at the end of the lease rather than being stuck with a depreciating asset. Option 5. A separate line of credit. Once your main financing is in place, immediately apply for a separate business line of credit. Do this before you need it, because the time you need it is the worst time to apply. A line of credit is revolving. You draw on it when you need cash, pay it back, and draw again. It's not for startup costs. It's your operational safety net for payroll during a slow month, an unexpected equipment repair, a gap between when you deliver services and when insurance pays, an opportunity. A piece of equipment comes available, a space opens up. Most licensed healthcare professionals qualify for a line of credit with relative ease. Lenders know that a licensed physician, NP, PA, dentist, or other credential provider has earning capacity that's about as reliable as it gets. If you can fog a mirror and hold a license, you can generally get a line of credit. Use that. Apply for the line of credit at the same time as your main loan or shortly after closing, while your financials are fresh and your relationship with the lender is warm. Option 6. Non-provider partners and investor capital. Here's an option that most physicians don't consider seriously, but should. You can bring in non-physician investors as equity partners, but you have to structure it correctly. Most states have corporate practice of medicine laws that prohibit non-licensed individuals from owning a medical practice directly. That doesn't mean they can't invest. It means the structure has to be right. The most common approach is a management services organization, or MSO. Here's how it works. Your PLLC owns and operates the medical practice. Only you, as a licensed provider, can own that entity. A separate LLC is formed to provide management services to the practice. This is the MSO. Your non-provider investor owns a stake in the MSO, not the PLLC. The MSO charges the practice a management fee for services rendered, billing, HR, marketing, facilities, equipment leasing, administration. The investor's return comes through the MSO, not the clinical entity. This structure is well established, widely used, and legally sound when set up by an attorney who knows healthcare law. Private equity uses this exact model to invest in physician practices across the country. What can the MSO provide? Almost everything except clinical care, real estate and facilities, equipment ownership and leasing back to the practice, billing and revenue cycle management, marketing and patient acquisition, administrative staffing, technology infrastructure. The limitations are real and must be respected. The physician retains full clinical autonomy. The non-provider partner cannot direct clinical decisions, influence treatment protocols, or control hiring of clinical staff. The management fee must be set at fair market value. It cannot be structured as a disguised profit-sharing arrangement that violates fee-splitting laws. And the setup must comply with your specific state's corporate practice of medicine rules, which vary significantly. Done right, this model lets you bring in a business-savvy partner with capital who handles the operational side while you focus on clinical care. That's a genuinely powerful combination. Option 7. Buying in or partnering with an existing practice. If starting from scratch feels overwhelming, consider buying into an existing practice. You pay a negotiated buy-in, typically based on a multiple of collections or a Goodwill valuation, and become a partner in an established operation with existing patients, staff, and cash flow. The financing for this is often more straightforward than a startup because there's a track record. Lenders can see historical revenue. The risk profile is lower. You can also structure a sweat equity arrangement. You join the practice at a reduced salary in exchange for building equity over time, with a buyout formula defined up front. This requires less capital, but more time. Option 8, seller financing. If you're acquiring an existing practice and the seller is motivated, ask about seller financing. The selling physician carries a note. You pay them directly over time rather than borrowing from a bank. Sellers often prefer this because they get a better price and a stream of income in retirement. You benefit because the terms are often more flexible than bank financing, and the approval process is between you and the seller. This works best when the selling physician is retiring, has a strong existing patient base, and wants the practice to continue successfully. They have skin in the game and a reason to help you succeed. Option 9, practice acquisition loans and Goodwill financing. One of the most misunderstood aspects of buying a practice is Goodwill, the value of the patient relationships, the reputation, and the established brand beyond the hard assets. Conventional banks won't finance Goodwill. Healthcare-specific lenders will. If you're acquiring a practice where a significant portion of the purchase price is Goodwill, go directly to a healthcare lender. This is their specialty. Putting it together, a typical financing stack. For most physician practice startups, the financing doesn't come from a single source. It comes from a stack. 1. SBA 7A or conventional term loan. Covers the bulk of startup costs. Leasehold improvements, initial equipment. 2. Equipment financing. Covers major equipment separately, preserving the term loan for operations. 3. Business line of credit. Operational safety net, applied for at closing. 4. Personal investment. Most lenders want to see 10 to 20% of startup costs coming from you. It shows commitment. 5. Investor capital via MSO. Optional, but worth considering if you want a business partner or need more capital than debt alone provides. A word on student loans. Many physicians hesitate to take on practice debt because they're already carrying significant student loan balances. Lenders are aware of this, and most healthcare lenders factor it in differently than a consumer lender would. Your student loan debt doesn't automatically disqualify you. Your income potential as a licensed provider is the counterweight. That said, get your student loan situation organized before you apply. Know your balances, your repayment plan, and your monthly obligation. Income-driven repayment plans can make your debt-to-income ratio look much better on paper. The bottom line. There has never been a better time to finance an independent practice. Lenders understand the model. Healthcare-specific financing has matured significantly, and the tools to bring in non-provider capital through an MSO are well established. The physicians who don't launch aren't being stopped by lack of financing options. They're being stopped by not knowing the options exist. Now you do. I'm Dr. Stephen Smith. I'll see you in the next video.